Welcome back, everyone. Today we're going to be talking about how to trade earnings using options and get all the exposure to the upside, or a lot of it, while mitigating risk and reducing, if not eliminating, that big potential downside. Because we all know that there's some great things about trading earnings and some not so great things, right? You're playing both sides. If it works against you, you are in a world of trouble. If it goes your way, everything is great, but we don't want to trade YOLO style. We don't want to be reckless. So how do you mitigate risk? What do we do? Well, I'm going to use Tesla as an example because Tesla just seems to be such a favorite and is the most requested security when it comes to options trading for earnings. But this applies to everything. You can use the same strategy. Now, really quickly, a little bit about myself to those of you who are new here. My name is Peter Tarr. My Twitter handle is PROFITSTAKEN. I became a professional licensed trader as well as an options and derivatives specialist. I was licensed for that as well. In 2005, I've been trading for quite a long time, and I post all of my trades in advance. I'm putting a few of them up here just so you can get a feel for some of the recent highlights that we had. I do everything in advance. When I approach trading, it is multi-directional, multiple data points. I don't just look at technical analysis. I don't just look at options flow. I don't just look at some of the fundamentals. You have to look at everything. That's how stocks work. Even sentiment. Sentiment drives purchases. So we take a well-rounded approach. I take a professional approach, time-proven professional approach to my trading. So there's no YOLO trading. There's no let's take calls and puts just so that I can make sure that I'm right. I don't do that, and I criticize those who do because it's an easy scam. It's a numbers game. So with that said, you know that this is more serious trading. You have to be disciplined in your approach. Let's talk about Tesla, and let's talk about one of my favorite things, that's risk mitigation. Because if you're interested in building wealth, risk mitigation is always at the top of your mind. If you're interested in some YOLO trading and having some fun, there's a lot of casinos you can get it done a lot more quickly. But if you just have fun trading options and seeing wherever your money goes, that's a casino for you as well. So let's take a look here. So this was Tesla's earnings, and we're back here at 10:21. Today is not 10:21. You'll probably hear the closing bell. Today is January 24th, and we have earnings coming up. But I wanted to use this as a prime example. This was an area where I made a lot of money, and I know a lot of people who lost a lot of money. And we're going to break down what happened, and I'll talk about what I did differently. I didn't have a crystal ball, and there's no fake pretending. It was simply strategy. It went my way, and let's get right into it. So take a look at the close of Tesla here. We close out at 865. Earnings come in. Earnings are very positive. I was expecting positive earnings. It was not only that the earnings were good, guidance was fantastic. And we know that's critical because if you want to see the future, what's going to happen to the security, it's all about the guidance, right? So if you're hitting earnings and you have great guidance, we're going to see something very positive, all else equal, and vice versa. You don't want to disappoint on earnings. And Tesla certainly didn't. Tesla came in pretty strong on their earnings. As you can see here, their actuals 186 over 96.2 projected. So that's strong. Their call was very positive for future guidance, and their deliveries the week before was very positive. So just to speak a little bit to the fundamentals, I know a lot of people think it's as easy as saying, oh, there's a support and resistance here, and if you draw a line in the graph, we'll crush those fundamentals. It's not a team game, guys. Anybody who speaks tribally like that is a little kid who doesn't know what they're talking about and is probably trying to run you up on a scam to get you in their Discord group. No serious trader ever speaks that way. We have to look at everything. So everything is great with Tesla, right? Positive. We're expecting something to go our way. So let's say that you buy options that close you at 865. What happens here after hours? This doesn't make sense to you, right? That's how the market works. It does make sense, but you're probably just not seeing what's going on behind the scenes. So we go from 865. We open the next day at 855. If you got in on options, you got absolutely killed. Even though directionally, in the end, you would be correct, as you're going to see here, like look at the massive run-up we have, you get absolutely slaughtered. And you're faced with a really tough decision because it's not just the pullback at 10 points, which is very significant. You're also seeing a huge IV calm down, so the premium on your contracts is going to drop like a rock. This, you're looking at more than 50% haircut. And to demonstrate that, I don't want you to just look at the underlying. I'm going to bring in the options contracts themselves. Take a look here. So this is the historical options contract, right? And I just picked one that was close to the money. So it's 865 close. I picked the 860, and these are the calls. So we have 860 calls. We're thinking, okay, great results. Everything's going well, right? Here's what it opens at. Because you get a loss in the premium due to the IV. There's not as much interest. There's not as much push behind calls. Look what you open at. Sorry, this is the opening price. It's the bottom of the green candle, right? You're opening at $7. After paying, let's see what your premium was. $2,085. So $2,085, that means if you just wanted one contract, let alone 5 or 10 or more, just on one contract here, you took a huge hit. You went from $2,085 or $2,085. You opened the morning at $700. You are down, and it is vicious, and you're faced with a choice, and you're probably going to cut your losses. Maybe you're going to say it's YOLO time. None of this is good, by the way. If you say, oh, I was one of those people who held anyhow. Well, if you're one of those people who holds when you're down 60%, that means you're holding down 10, 20, 30, 40, 50, 60 anyhow. That's a horrible trader. You're going to lose a lot of your money. You might get lucky sometimes, but you'll be out of the game really quickly because you can't continue to hold when you're taking big losses. So here's a perfect example to all of you trying to see some of the volatility overnight. We saw that drop. It was only 10 points, but look at the drop in the premium. It's actually more than the underlying, right? We see a 13-point drop. And again, that's because the IV dropped tremendously because the speculatory period was coming to a close. Now, we see that over time it takes off. For a lot of people, you've got the open and you actually see it dip down a little bit more. You might have just cut your losses because you're already brutalized, you're demoralized. Maybe you get up a little bit higher and think, oh man, I don't know how high it's going to go. I just want to cut my losses. If you even get close to break even, you're out with a lot of heartache and you're probably one of the lucky ones. And you still made a mistake. You still held on too long from a technical standpoint, from a disciplinary standpoint. I'm talking about trading to build long-term wealth, not you held and just got lucky. So we see the potential overnight when you swing this trade, right? Now, if you were short, yeah, it went great. And there's a lot of opportunity in swinging a trade. But what I'm showing you is that you can get brutalized overnight and you never have the opportunity to cut, right? So we close at $2,085 or $2,085. You couldn't get out of that position when it was tanking. You're stuck with a $1,300 loss per contract. So what do we do about that? There's nothing we could do to trade the options after hours. How do we mitigate that risk and still get a touch of the upside? Well, what I'm here to explain and how I benefited very well was I looked at this as very positive for Tesla, and I did my fundamental work and I looked at the sentiment. I looked at technical analysis and options flow, which options flow is very obfuscated during this period of time, just as an FYI, because there are options going in every direction and they're going at high premiums. So it's pretty hard to read. So what I did is I bought early on. I felt like this was just too much of a pullback. My fundamental data, that my technical data, everything was telling me that this was too much of a pullback and we're going to get an upswing. So I bought in early, and you can see what Tesla did. And if you know my trading style, you know that I would hang on. I might have a little bit of a sell-off here. I keep some size. I'd keep this size. I probably would have sold a little bit more here. And then you see that we have a very positive day as it flows through. This was a very profitable day. But I want you to understand that too. You don't have to swing overnight. So what is the other reason? Not just the IV. You're losing on theta. Remember? That's time decay because a day passes here. So you're already behind the ball when you swing. When you swing, you have to go overnight. So no matter what, your gains have to make up for theta. That's time decay just for you to break even. So look at this trail off. And we're going to go back and look at the underlying. Here we are. We get a big pullback. You could have bought in here. So this is a 5-minute chart. TD won't let me do the 1-minute chart, which I really prefer. But you'll see there was a lot more opportunities because we did have a pullback. And TD won't allow me to do that because it's only up to 180 days that you could do 1 minute. And we're going a little further historically, but I wanted to show you the options price historically as well. So now, what do we do? Well, one of the things that I love doing, as I was explaining, is I won't buy at close. I won't buy the day before, because if in the day before, every day that I wait, I have to tolerate and withstand the theta loss, right? So if I lose a point overnight, I have to make up an entire point just to get back to even for what I lost on the time decay. No, rather than that, I let this erratic price action move around. And yes, you can benefit a lot, right? So if we close here and we actually open up here, there's your lotto play. I'd rather take it the day of. Why would I rather take it the day of? Well, okay, a lot of things have calmed down and it's a little bit more straightforward on price action. So you're not seeing IV so inflated that it distorts where your price should be. But the main thing, and we talked about mitigating risk, is, I'm sure you can all guess it, I can exit. I can exit my position. I can trade out, right? We opened here, as I just showed, $2,000, $2,085, and we dropped down to $1,300 to $7. Well, guess what? If something like that starts happening here, I'm down 10%, I can cut. I just did the snap fingers for sound effects. I can cut. I can cut out of my position. I can exit my position. I can re-enter a position. I could take advantage if I don't like what I'm seeing. During this after hours period, you are stuck. You're not trading underlying. You're trading options. You're stuck. You're taking the theta loss. You have absolutely no control. You're sweating, waiting for the morning. And if the first thing when you open your eyes and you look at your phone and this is what you saw, or this is what you saw because it's the morning, you're not feeling too good. You have to go through all that stress. But the number one thing is the risk mitigation. There is a place for it in my portfolio, but unless you have a large portfolio, you've accumulated wealth, you probably don't want to enter these sort of positions. And even if you do, you don't enter them very heavily. That's YOLO trading. That's throw it all on red or throw it all on black and we're playing roulette. Trade during the day. I don't trade the day before before earnings. I trade the day of earnings. And as you can see here, if you're trading in on Tesla, let's say you bought a few contracts, you shed a few around here, look at that move. You go from 855 open, okay, great. You scale out at a little bit at 883, then you make another run up, you scale the rest out at about 890, 891. That is a phenomenal day, and you will see when you look around, there are options like this all across the board. Options is a bit of a pun there. But I mean, you have choices. You can do this for any stock that you want. And the big thing that you have to ask yourself, do you want to have control to mitigate risk? Because in fact, there's more volatility and activity after open than there was after hours. It's not always the case. Sometimes I'd say more frequently you see after hours there's more volatility, but a lot of the time there's more volatility. There's that bell I warned you guys about. The day's closed. There's more volatility during the day. So we want to taste of that volatility. Volatility is your friend. As an options trader, as a day trader, you don't want erratic action, right? So that's a certain type of volatility. You don't want it chopping and knocking you out of your trades. But volatility, this is price volatility where we're shooting up in one direction. You take it during the day, you can exit, you can cut, you can take your profits. You are stuck after hours. So why not give yourself exposure to that upside without this horrible downside? And when I say downside, the consequences here are extreme. You know, you lost over 50%. You're down about 70% when you start the morning. That's really tough. And again, what's also going to get you is not just the theta, not just the move that you have to tolerate, but it's also a drop in IV. So it's almost like it's working against you twice as hard if things don't go your way, because you're going to be going out of the money faster and faster and faster. Again, you want to take a different approach to it. You're a little bit nervous about earnings. Use disciplined trading methods, which I detail on this channel. I talk about how to maximize your profits. If you look at that video, I'll try to post it up here as well, and you can just go to my channel. Look at that video that teaches you how to exit trades like a professional. Mitigate your risk. Don't let one shot wipe you out. I can see a lot of people who probably got in here, 5, 6 contracts thinking Tesla, 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 and it just broke their hearts here, right? Broke their hearts, broke their accounts, and they said, forget trading. Trade like a professional if you want professional results. Trade with discipline. Don't trade like it's a casino. This is a method that I use rather frequently because I'm confident in my day trading skills, which I explain all over this channel. And be sure to take a look at the live videos. So when you're on my channel, you click down, it will show you the live videos as well. There's videos and live videos. Just go to all, because the live videos are where we go over a lot of questions and answers. We go over a lot of use case scenarios so you can see exactly what I did on different trades. Of course, follow me on Twitter at PROFITSTAKEN. You've seen some of the results. And I use unusual whales as a basis for almost all of my trades. It's included. I always review the options flow data. So if you're interested in trying unusual whales, give it a shot before you make a decision. Check the description and use my discount code. All right. Thank you all. I hope this helps you out. I hope you trade better as a result, and we'll see you next time.